What causes the crypto market to pump or dump? In short, it's crypto-specific factors like Tesla buying Bitcoin, or macro factors like the Federal Reserve raising interest rates. Sometimes it's a combination of both. Now, the effect of crypto-specific factors on crypto prices are often straightforward. However, the same can't be said for macro factors. Sometimes they don't move the crypto markets at all. Researchers at S&P Global recently released a report revealing exactly how and when macro factors move crypto markets. So today, I'm going to tell you all about it. The report I'll be summarizing today is aptly titled, quote, "Are crypto markets correlated with macroeconomic factors?" It was published earlier this week, and I'll leave a link to the full report in the description if you're interested. Now, the report begins with a brief introduction wherein the authors explain that crypto is seen by most investors as a risk asset. As such, macro conditions that are favorable towards risk assets, such as low interest rates and low borrowing costs, tend to have a positive impact on crypto prices. Amazingly, the authors acknowledge that this could change. Over time, cryptocurrencies like Bitcoin and Ethereum could start to be seen as more analogous to, say, commodities rather than risk assets. The authors note that the increased involvement of both retail and institutional investors could be the cause. The authors then explain that they assessed how changes to macro factors impacted the crypto market between 2017 and March 2023. This is a fascinating timeframe to choose because it's believed that institutional investors first started getting involved in the crypto markets in late 2017. More about that in the description. In any case, the authors go on to break down the 5 questions about crypto and macro that they want to answer. These are: 1. Does monetary policy matter to crypto markets? 2. Does the perception of the possibility of an incoming recession matter for crypto markets? 3. Can crypto assets be a hedge against inflation? 4. What does a strong or weak dollar mean for the crypto markets? And 5. Do financial stress and market volatility spill into the crypto ecosystem? I'll quickly note that the wording of the second question is very significant. As some of you will know, the markets are forward-looking. This means that today's prices reflect the expectations of what's going to happen in the future. As a fun fact, it's believed that the crypto markets are the most forward-looking of all. Anyways, the authors then of course start with the first question. Does monetary policy matter to the crypto markets? Well, the short answer is yes, because lower interest rates result in an increase in the money supply as measured by M2, and crypto is highly sensitive to increases in M2. Note that M2 has been falling. On that note, the recent decline in M2 suggests that the crypto market may not be as sensitive to M2 as the authors portray. The crypto market has been rallying since the start of the year. This could mean that the crypto market is more correlated to the global money supply, which was increasing until recently. Now, the authors also ask a handful of other questions related to the impact of monetary policy on the crypto market. The first is if crypto prices are correlated to future changes in interest rates. To answer this question, the authors compared the S&P's crypto index to the interest rates on 2-year US bonds. As you can see, the crypto market and 2-year yields have an inverse relationship, meaning that when the 2-year interest rate increases, the crypto market falls, and when the 2-year interest rate decreases, the crypto market rallies. Note that 2-year US bonds basically reflect 2-year expectations for interest rates. The second sub-question is if quantitative easing and tightening affect the crypto market. In other words, does the Fed buying US government debt, easing, or selling US government debt, tightening, impact the crypto market? As you can see, easing causes a rally and tightening causes a crash. This correlation is even clearer when you compare the crypto market with the size of the Fed's balance sheet. As the Fed's balance sheet expands, the crypto market rallies, and as the Fed's balance sheet contracts, the crypto market crashes. Note that the Fed's balance sheet has been contracting recently. Now, the third sub-question is if M2 levels impact the crypto market. For anyone wondering, quote, M2 is the US Federal Reserve's estimate of total money supply, including all of the cash people have on hand, plus money deposited in checking accounts, savings accounts, and other short-term saving vehicles. As you can see, the money supply, as measured by M2, is positively correlated with the crypto market. However, the authors highlight the fact that the crypto markets continued to crash in 2018 despite the increase in the money supply. This underscores the idea that there's more to the story than M2. The authors then rightfully conclude that, quote, in general, crypto markets have performed well in periods of expansionary monetary policies, although we are not able to establish a causal relationship. They note that crypto-specific factors like FTX collapsing can be more important than the M2 money supply. This begs the question of whether we could see a similar phenomenon occur during this bear market. Put simply, could the crypto market continue to crash due to a crypto-specific factor even though the M2 money supply is increasing? I suppose this all depends on whether crypto is actually in a bear market. You can find out why crypto could be in a bull market using the link in the description. Anyhow, you'll hopefully recall that the second question was whether the perception, keyword, of a possible incoming recession matters for crypto. The authors give the answer straight away. Recessionary risks could weigh on the crypto markets, assuming they're large enough to affect risk asset allocations. What's interesting is that the authors use the difference in interest rates between 3-month yields and 10-year yields to assess recession risks. This is interesting because most people watch the difference between the 2-year and 10-year yields. One of the only exceptions is Fed Chairman Jerome Powell. The authors then say that comparing the 3-month to the 10-year is more accurate. Interesting indeed. Now, as most of you will know, if shorter-term interest rates are higher than longer-term interest rates, then this is a sign that a recession could be coming. The authors note that one of the only times a yield curve inversion didn't result in a recession was the most recent inversion. Too soon to say, I reckon. Regardless, as you can see, there seems to be a positive correlation between a yield curve inversion and the crypto market. The authors say that there isn't enough historical data to say for sure, but it appears that the crypto market declines both when the yield curve inverts and then again when it starts to revert. This makes sense considering that a reversion of the yield curve typically happens when the Fed starts lowering interest rates in response to a financial crisis of some kind. Contrary to popular belief, the markets crash when the Fed pivots because the latter is usually done in response to the markets breaking. Incredibly, the authors then acknowledge that crypto could be seen as a safe haven in the event of such a crisis, and note that people in countries with weaker currencies have been adopting crypto. They even admit that it's being used as legal tender in some countries and could play the role of money. Based. That said, it's more than likely that crypto continues to be seen as a risk asset by most investors, not as a safe haven. As the authors point out, however, this could change over time, and I have a feeling it will change after central banks start holding crypto on their balance sheets in January 2025. More about that in the description. Anywho, this ties nicely into the third question, and that's whether crypto can be a hedge against inflation. The authors start by saying that there have been periods where crypto's price action was inconsistent with macro factors. They stop short of saying that this is why people should invest in it. What's strange is that the authors define inflation as an increase in demand via the money supply or a shortage of actual goods and services on the supply side. As Milton Friedman famously said, quote, inflation is always and everywhere a monetary phenomenon, i.e., it's caused by the demand aspect. This is important to point out because crypto clearly isn't a good hedge against inflation caused by a shortage of supply of actual goods and services. However, crypto clearly is a good hedge against inflation caused by the demand side, an increase in the supply of money chasing the same goods. Not surprisingly, the authors found that the crypto market isn't correlated to their broad definition of inflation, which they measured using 2-year and 10-year inflation expectations. Also, not surprisingly, they found that gold prices are correlated to inflation expectations. Gold goes up as expectations increase. To their credit, the authors acknowledge that crypto is an effective inflation hedge in many developing economies. Oddly enough, they say that crypto is used by some countries to evade sanctions and that this, quote, complicates the study of crypto as a counter-inflationary asset. This makes no sense. Case in point, gold is also reportedly used to evade sanctions, and yet it's a perfect inflation hedge. Logically, the demand for both gold and BTC should rise during inflationary periods by countries using them to evade sanctions because they would theoretically be the strongest currencies besides the USD. To be clear, I'm not advocating for sanctions evasions here, just correcting the record, stating the facts, if you will. And this relates to another acknowledgement by the authors, and that's that the supply of cryptocurrencies also impacts their ability to be inflation hedges. They note that the supply of BTC will continue to increase until 2140, whereas ETH has occasionally been deflationary and could continue to be. Speaking of which, if you're wondering what happens to Bitcoin when the last BTC is mined, be sure to check out our video about that using the link in the description. Now, the fourth question is the most interesting one, in my opinion at least, and that's whether US dollar strength or weakness impacts the crypto market. The authors start by saying that crypto prices generally decline when the US dollar is strong. The same is true of most other assets, not just risk assets. Rather than measure dollar strength using the DXY, the authors use the nominal broad US dollar index, which, quote, tracks the currency against a weighted basket of currencies used by US trade partners. They reason that investors should favor other currencies when the US dollar falls, including crypto. As you can see, the stats suggest that crypto prices tend to increase when the US dollar declines. However, the authors highlight the fact that there can be lags between these effects. This again underscores the fact that crypto-specific factors can sometimes take precedence over this macro factor. The authors argue that there's no causal relationship between a decline in the USD and an increase in crypto prices, but I reckon there is. You see, the USD and other currencies are ultimately just assets at the end of the day. They experience volatility like all other assets, they're just much less volatile. So, when you do see volatility among currencies, chances are it's because there's flight to safety among investors, everyone moving out of other assets and into cash. Obviously, the inverse is true. If the US dollar is declining, then it generally means that money is moving out of the USD and into other assets. The reason why the causal relationship isn't apparent to the authors is probably because of the perception aspect of investing. Recall that markets are always pricing in what's going to happen next. This means that crypto can sometimes rally next to the USD. The crypto market thinks the USD will fall. The evidence for this can be seen in the author's own statistics. Notice that the crypto market has collapsed every time there was an unexpected rally in the USD, like at the start of the pandemic. The crypto market also rallied every time there was an unexpected collapse in the USD, like earlier this year. In case it wasn't clear enough, expected rallies in the USD are caused by crises of some kind. Not only that, but the USD initially continues to rally even when the Fed starts cutting interest rates and engaging in quantitative easing. It's only after investors have calmed down that risk assets start to recover and rally. So, the next time you see the USD go on an unexpected rally, remember that this could crash the crypto market for a few months. Also remember that the Fed's emergency measures won't cause a rally until investors have started to calm down. Not financial advice, but stay calm, if you catch my drift. Now, the fifth question pertains very much to the previous one, and that's whether general market volatility can spill over into the crypto market. The authors start by stating the obvious, and that's that yes, the general market affects the crypto market. They measure this using a financial stress index. As you can see, when the financial stress index turns positive, i.e. lots of financial stress, then the crypto market crashes. Conversely, when the financial stress index turns negative, the crypto market starts to rally. The correlation here is truly striking. Dare I say, it's the best I've seen that predicts crypto cycles. The authors also examined the correlation between the VIX, which tracks stock market volatility, the VIX for oil, and crypto market prices. Here we see a similarly striking correlation where volatility in stocks or oil result in a crypto crash. The authors chose the oil VIX because of Bitcoin mining's energy use. Smart. What's not so smart is that the authors claim that stress in the crypto ecosystem can spill over into the banking sector. They make this claim because crypto-exposed banks don't have control over the crypto market. This makes no sense, and it's clear that the exact opposite is true. Banking can hurt crypto. To add insult to injury, the authors even admit that the banking crisis caused the USDC stablecoin to depeg. They also note that this caused chaos in crypto's DeFi ecosystem and warned that this chaos could have spread to the rest of crypto if it wasn't contained. More about USDC's depegging in the description. Now, there are two things to keep in mind here. The first is that indicators like the financial stress index, the stock market VIX, and the oil VIX are all fundamentally analyzing the same thing from a slightly different angle. That's why it's best to use multiple indicators to make sure you get the full picture. The second thing to keep in mind is that most stablecoins in circulation are backed by US government debt, aka US bonds. The US bond market has a volatility index of its own called the MOVE. The MOVE index exploded when USDC depegged. This wasn't the cause, but it's an important correlation. So, the next time you see the MOVE index explode, don't be surprised if you see stablecoins depeg. The MOVE index could rally because US bonds are considered a safe asset and investors are buying them with increasing speed. The MOVE index could also rally if US bonds suddenly become less safe due to, say, a debt ceiling debate. Speculation aside, the authors conclude that crypto will become ever more affected by macro factors as it becomes more common among investors. They also caution that crypto could affect other markets if institutions get too involved, a notable change from their otherwise pro-crypto commentary. Now, to wrap things up, I want to give you my take on why macro factors can have a hit-or-miss effect on the crypto market. In short, it's because the crypto industry is still evolving. Investors are still trying to assess whether cryptos are risk assets or something else. For now, they continue to be risk assets. This makes sense considering that the implicit and explicit purpose of cryptocurrency is to replace the existing financial system. This is a massive undertaking, and as time goes on, it's becoming clear that some cryptos want to integrate with the existing system, and other cryptos have non-financial use cases. This makes it even harder to tell whether cryptos are risk assets or something else, and it foreshadows a decoupling among major crypto categories. Some cryptos, like BTC and ETH, will be considered low-risk commodities. Others will be considered high-risk securities, analogous to stocks in companies. It's unclear when this decoupling will take place, but I presume that a prerequisite is reasonable crypto regulations around the world. Crypto regulations will allow for the kind of price discovery that's required for investors to understand which cryptos fall into which categories, and this process will take time. From where I'm standing, it looks like this process will begin during the next crypto bull market if most countries have passed reasonable crypto regulations by then. Given that reasonable crypto regulations are probably a prerequisite for a new crypto bull market, it's safe to assume they would have passed. What this means is that the next crypto bear market could look completely different. We could see cryptos like BTC and ETH keep most of their bull market gains, while more speculative altcoins get absolutely wrecked. Some would say that we're starting to see this in the current crypto bear market. In sum then, crypto is about to enter a very interesting period of price discovery, which will likely go in both directions. If you manage to keep track of how different cryptos are responding to different crypto and macro factors, you will be perfectly positioned for a once-in-a-millennium investment opportunity. Now, this is much easier said than done, but it is doable, and it all starts with understanding which crypto categories to watch during the next crypto bull run. As it so happens, we just did a video about that very topic, and you can find it using the link in the description. You are welcome. And that's it for today's video. If you found it as thought-provoking as I did, give that like button a poke. While you're at it, press that subscribe button and punch that notification bell to make sure you don't miss any videos from the Coin Bureau. If you happen to be looking for a hardware wallet to store your crypto or want to save on trading fees, you can check out the Coin Bureau deals page for massive discounts on hardware wallets and huge discounts and incentives on the top crypto exchanges. The link will be down in the description. Thank you all for watching, and I will see you next time. Till then, stay cool, stay safe, and stay crypto.